Hi everybody and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, bringing to you people the debrief of question number 3 from the AFM Pre-December 2025 mock exam. So as you can see, the question is right in front of you. The name of the case study is Mackosso Company. So here we are given with all of this information on either of the sides of the screen, left as well as the right hand side. So firstly, if I quickly take a look at my right hand side, I can see that the following exhibits available on the left hand side of the screen provide information relevant to the question. First exhibit tells me about the company background and the potential target. Second exhibit tells me about the acquisition and the financial details. This information should be used to answer the question requirements within your chosen response options. So this is a requirement worth 25 marks and three parts are there. If I answer these, I will be able to fetch these 25 marks that are available in the paper. Now, the very first requirement wants me to discuss potential reasons why Mackosso Company's planned acquisition of aid company may not be successful. So for 4 marks, I have to discuss reasons why the acquisition may not be successful. So multiple times this aspect has been tested in the exam, so no surprises here. Second requirement asks you to estimate the percentage gain for aid companies shareholders under each of the above 3 payment proposals. This is worth 12 marks. And then for 4 marks again, I have to discuss which payment proposal aid company would most likely accept, would be most likely to accept if an offer is made by Mackosso Company. So we have to do our calculations and then we can use those calculations and give our answer for the part C. Now, all of this is worth 20 marks in total, and then 5 marks are available for professional skills, where I have to demonstrate analysis, evaluation, skepticism, as well as commercial acumen in my answer. So these are all the requirements. Now, let's have a look at both of the exhibits that are given to us. So the first exhibit is that Mackosso Company is a listed company producing health supplements which it sells around the world. It is known as a high-end premium quality brand. So this is something which I can highlight. This is what they do. And so the selling prices tend to be higher than many other companies who are offering the similar products. Most of Mackosso Company's success has come from selling through retailers like pharmacies, health shops, and supermarkets. Its products are not yet available to buy directly from Mackosso Company online. So we sell only through the retail channels and not on our own directly. Second paragraph tells you that Mackosso Company is considering making an offer to acquire Aid Company, an unlisted company known for producing and selling protein powder at affordable prices. Okay, so we are thinking to acquire another company who does the same thing, but they are catering to a different sort of audience. We are producing health supplements, which we sell as a premium quality brand, and then Aid Company makes protein powder, which you can also say is a part of the health supplements only, and they sell it at the affordable prices. Now, Aid Company has been chosen as it would provide quick access to the protein powder market for Mackosso. It has also a strong social media presence, which Mackosso Company is lacking, and is highly popular with 18 to 25 years old who regularly post photos of themselves with Aid Company branded products. So they have a good social media presence, because of which Mackosso Company is attracted to Aid Company. Aid Company shareholders have previously suggested that they could be willing to sell the business for the right price, with the rumors that they would be happy with anything above a 12% gain on their current estimated value. So as long as they get a 12% return, they could be willing to sell the business if they are getting this much percentage of return. This is what the rumor has been. So this is all the information that I gather from the first exhibit. Mackosso Company, we are a high-end premium quality brand. Then you are thinking to acquire somebody who does similar business, but then they are catering to the affordable prices. That means the target audience is different for both of these businesses. And then further, I get to know one more reason why I, as Mackosso company, am more attracted to Aid company because of the social media presence that they have. And then lastly, I get to know that the shareholders may be willing to sell me if I offer them a 12% higher value than the current estimated value. So this is all that I get to know from the first exhibit. Now let us proceed to exhibit number 2, where all of the acquisition and financial details have been provided to us. So if I just make it a little bit bigger, Mackosso company proposes to pay for the acquisition using one of the 3 proposals. Proposal 1 is where we make a cash offer of $10.50 per share of Aid company. Second proposal is where we offer one of 8.5% coupon bond in exchange for every 10 Aid companies shares. The bond will be redeemed in 3 years at its nominal value of $100. Or proposal number 3 is that we can make an offer of 2 of our own shares for every share in Aid company. Now, the extracts from the latest financial statements for both companies have been given to us, Mackosso and Aid. We know their revenue, we know their PBIT, we know their tax payments, and lastly, we know their profits after taxes. Then, with respect to Mackosso company and Aid company, we have the balance sheet related information, non-current assets, liabilities, current assets, current liabilities, as well as the share capital. Lastly, they are telling us that Mackosso company's current share price is $5.50 per share. Listed companies in the protein powder industry have an average PE ratio of 15. Both companies have a nominal share price of $0.5. Mackosso company's non-current liabilities include a 8% bond redeemable in 4 years at par, which is currently trading at $110 per $100 of nominal value. Mackosso company estimates that synergy savings by combining the office space, reducing the staff headcount, and selling excess non-current assets could increase the value of the combined company by $5 million. So this is the amount of synergies which I am expecting when I acquire this new company. So this is all the information that is available with me. Using that information, I have to solve all 3 parts that have been asked from me. So let us first solve the very first part, where we have to discuss the reasons why the acquisition may not be successful. So what I've done is, to save time over here, I've already drafted the answers for you people, and I will be explaining you through all of these points, that how and what could be explained. Now, for 4 marks here, we are talking about the reasons why the planned acquisition may not be successful. So the very first thing that you can put over here is the brand clashes. So we know that Mackosso is a high-end premium quality supplements brand, while Aid company is catering to the affordable price segment. So if we as Mackosso company acquire Aid company, the brand image can be confusing to the customers. Second, you can talk about the synergy issues. The $5 million that we have estimated, this is very crucial for the success of the acquisition, but it's not necessary that we will be able to get all $5 million of benefit. We may be wrong also. So Mackosso company may face lower than expected savings. So we are thinking right now we will have savings of $5 million, but that may not come to be true. And if that happens, this is not going to have as much savings as we thought. So if, let's suppose, we were not able to sell our assets for as much as we were thinking, or if we are not able to lay off all of the staffs, whatever could be the reason, so then synergy issues are also possible. Another factor that you could say that could cause a payment or a problem over here is the overpayment. So Aid company's valuation is going to totally depend upon the recent earnings that will be continuing in the future, because we are given the PE ratio. That means I'll use the PE ratio to find out the value of Aid company. So if, let's suppose, my assumptions are wrong, I may end up paying extra to Aid company, and I may even fail to recover my initial investment. And then lastly, you can talk about the cultural clashes of the staff. So whatever aid company is doing well, they're able to do it because of the good social media team that they are having. So whatever strength they have, it lies in the skilled social media marketing team who is very successful in targeting all of the audiences which are lying in the age bracket of 18 to 25 years. Now, this contrasts with Mackosso's B2B focus. How are we B2B? Because we at Mackosso, we are not selling directly to our customers, we are selling to pharmacies and health stores and so on and so forth. So, this is something which is going to be very different from what we usually do. So, these different skill sets and the way we do our marketing, this is going to create some of the problems when we try to integrate both of these businesses together. Conflicts are possible, and we may even have to lose the key staff. So, these are a few problems that can be faced while if Mackosso company decides to go ahead and acquire the aid company. So with this, we have addressed the very first requirement, which was worth 4 marks. Now talking about the part B, where they are asking you to calculate the percentage gain for aid company's shareholder under each of the 3 circumstances that we are thinking about. So part B, let's discuss. The requirement is right in front of us. Let's also open the exhibit where they have given us all the financial details. Here they are. And now on one side, I can open my spreadsheet where I can start doing my numerical workings. So I can make it look something like this. And this is where I can start doing my workings. I have to proposal wise calculate the gains in each of these proposals. So over my spreadsheet, what I will do is I will first have to see how much is the gain happening in proposal 1. So as far as proposal 1 is concerned, I am giving the shareholders of aid company $10.50 per share. So how much of gain they will be having, that is something which totally depends upon how much is the price right now. So if you want to calculate the gain, you would want to know the price now, then you compare it with the new price, and that is how you find out whether there's any gain or loss. So what you do is the first step is going to be to find out the value of aid company. So if we want to find out the value of aid company, we were given the PE ratio. PE ratio was given to us at 15 times. So what we do is we take 15 and we multiply this with aid companies profit after tax. So aid companies current value. So the current value that we have, it is going to be 1510 multiplied by the PE ratio, which is given to us as 15. So I'll multiply this with 15. This is the total value of aid company. Then what do I have to do is, this is something which is the total value of the company itself. Now, if I want to find out the value of one share, what do I have to do is I have to simply divide it by the number of shares. So for that, I will need the number of shares. How can I find out the number of shares? I can have a quick look at the balance sheet that was given to us. I have $1,200,000 of share capital, and it has a nominal value of 50 cents per share. So what can I do is, to find out the number of shares, I can simply take 1200 and divide that by 0.5. So this gives me the number of shares which I have with me. Now, if I want to find out the value of one share of aid company, this is going to come out to the total value divided by the number of shares, which will, if I just round it off to 2 decimal places, it'll look something like this. So this is the value of one share of aid company. Now I can go proposal wise to find out how much gain or loss is going to be there. So here I can talk about proposal 1. So within proposal 1, what we are doing is we are offering cash of $10.50. So right now I know that the value of one share is 9.44 and the cash offer The cash offer is 10.5. So how much is the difference? How much is are the shareholders going to gain? Gain on one share is going to be the difference. They are going to be paid 10.5 for something which is worth 9.44. So this is the amount of gain that they make on every share. So if I want to find out the percentage gain in this case, so the percentage gain is going to be the gain amount divided by your current value, which is 9.44. So this comes to 11.26%. So this is how you find out the gain under the first proposal where we are going for a cash offer. Now coming towards proposal number 2, where you are offering 8.5% coupon bond in exchange for 10 aid company shares, which will be redeemed in 3 years time at its nominal value of $100. So with respect to this, I will have to find out how much is the worth of this loan note or this bond in today's terms. So for that, I am given with information right at the bottom. So at the bottom, I'm being told that the non-current liabilities include an 8% redeemable bond in 4 years at par, which is currently trading at 110. So what do I need to do now is I have to find out firstly that how much is the yield which the investors get, and then I have to find out the value of the bond offered so that I can find out how much the shareholders are going to gain. So what do I do over here is I am being told that whatever the company has issued right now, that thing gets an 8% interest. So proposal number 2. Here I'm first trying to find out how much is the gross redemption yield, and then using that yield, I will find out the value of the bond. So what do I do over here is, firstly, they are telling me that the current market value for this particular bond that we have already issued is 110. So if I show my workings over here, workings for gross redemption yield. So for that, I will put my cash flows year-wise. These are bonds which will be redeemed in 4 years' time. So I start off with a negative 110, $8, $8, $8, and in the last year, I received the interest as well as what I have as a part of the redemption. So these are redeemable at par. That means they will be redeemed at $100. So if now I want to find out the gross redemption yield, I can simply find out the IRR. So equals IRR, hit enter, and 5.17%. This is what my gross redemption yield actually looks like. Now I want to find out how much are the shareholders going to gain. So for that, I need to know that how much is the value of these bonds that my shareholders are getting. So let us now find out the value of one bond. So if I want to find out value of one bond that we are offering, we simply have to discount all of the cash flows, bring them to present value. So what are the cash flows going to look like? They will be redeemed in 3 years at the nominal value. So the interest is going to be 8.5. So 8.5, 8.5, and in the last year it will be 108.5. Now I can find out the NPV. The rate of discount shall be 5.17%, and then I select all the cash flows right from the beginning till the end. So 109.04, this is how much is the worth of one bond. Now what do I have to do is I have to compare how much is the worth of one bond. I have just calculated value of one bond that the shareholders are going to get. So this is worth 109.04. Then the next thing that you have to do is you have to draw it to a comparison that who is going to get this. 8 companies shareholders will get one bond for every 10 shares. So they are getting basically this bond in exchange for 10 shares. Now let's see how much is the value of 10 shares. So value of 10 shares in a company. So we have just calculated value per share was 9.44. So 10 shares will be 94.44. So now you can find out the gain in terms of dollars. So the gain is going to be the difference between both of these numbers. And now when I want to find out a percentage gain, so the percentage gain is going to be equal to the money that I have gained divided by my initial investment, which is this much. So this comes to 15.54%. So in proposal number 2, this is the amount of gain which the shareholders of aid company are going to receive. Now proceeding further towards the third proposal that we have, proposal number 3. Proposal number 3, I am getting an offer of 2 of the shares for every 1 share of aid company. So that means when the new company is going to be formed, all the shareholders who were holding 1 share in the company, they are going to get 2 shares in the combined company. So how will this work is, I will first have to find out the value of the combined company. Value of the combined company. So how much would be the worth of the combined company? First, I have to take the value of Mackosso company. So within this, I have to take value of Mackosso company. So Mackosso company, I am being told the profit for the year is or rather we can also take, we are given with the value per share. So we are given with 5.5 is the value per share, and this I can multiply with the number of shares. How can I find out the number of shares? Total capital is 9,000, divide that by 0.5. So that will give you 18,000 number of shares. So this is how much is the worth of Mackosso company right now. Then I also know the value of aid company at the moment, which I've just calculated at the top. So value of aid company was this much right now. And then further, if the acquisition goes ahead, it was given to us in the question that we will be having synergies, and those synergies are going to be worth $5 million. So I put a 5,000 over here. That means the value of my combined company is going to look something like this. So now I can label this cell also. This is the value of combined company. Right? Now I know how much is the worth of the combined company. Now I have to see how many shares will be there in the combined company. So right now, the combined company will basically be, if I want to find out the number of shares in combined company, I know that if I talk about Mackosso company, so they have shares that are 9,000 divided by 0.5, which will give you 18,000. Further, to aid company, what we are doing is we are giving them 2 shares for every 1 share that they used to have earlier. So we just calculated what's the number of shares that they have. The number of shares which are available with them is 2,400, right? So 2,400 shares is what they have, and we are going to give them 2 for every 1. So 2 divided by 1 multiplied by the already existing number of shares, which I have as 2,400. So now the shares that will be given to the shareholders of aid company of the new company, this is how many number of shares are going to be there. So if I find out the total, this is the total number of shares in the combined company. Total number of shares in combined company. Now what do we have to do is, I know I can now find out that how much is the value of the share of combined company. So value of 1 share of combined company. So this is the total value of the combined company, and this will be spread over these many number of shares. That means the per share is worth these many. So now what we are going to do here is we are going to draw a comparison, that if you talk about how much gain is going to be there, so you can find out the new value of the company. you just know that the new value of the company, the combined company that you're going to have, it is going to be 4,800 number of shares which will be given to them, and 5.55 is what is the worth of one share. Now, if they find out the old value of the company, so old value of aid company. So the old value of aid company, we have just calculated 22,650. So earlier they were having a value of 22,650. Now with the new shares of the company, the shareholders value, the net worth is going to go up to 26,663. So how much gain do they make over here in absolute terms? You can find out the difference. This is the amount of gain. And now if you want to find out the percentage gain, so the percentage gain will be equal to the difference divided by the old value. So this will give you 17.72%. So this is how much gain you are going to have in each of the three proposals that we are dealing with. Now, how do we proceed with our answers? Ideally, just showing the calculations. Rather than that, it will be good if you also write down over here that what will happen under each of the proposals. So as part of my answer for part B, I've written, please see the spreadsheet for the calculations. And then proposal wise, I've given them a summary that what will happen under which proposal. So under the first proposal, 11.26 is the gain for aid company. Under the second proposal, it's 15.54. However, this is based on the assumption that whatever old bonds are being used by Mackosso company, same return we will offer on the new bonds also. And if the return is different, then the value will be different, and then the gain that we have calculated, that may also be incorrect. Thirdly, you could talk about the gain that is happening in the third proposal is 17.72. Here we are assuming that the synergies that we are forecasted worth $5 million, that is accurate. If these savings are not made, then this figure could be too high and the gain can be over exaggerated. The key assumption which we've used in all of the cases is, firstly, the share price that we are taking for aid company, which currently stands for 9.44. So how did we calculate that? We calculated that using the PE ratio of 15, which is suitable for aid company. Now this PE ratio that is given to us in the question, this is for listed entities. However, aid company is unlisted, so it may be too high, which will lead to the overvaluation of the shares of aid company. So this is how we are going to frame our answer for part B. Now let's talk about part C, where you had to discuss which payment proposal would be the most likely to be getting accepted by the shareholders of aid company if we are making the option, if we are giving this proposal by Mackosso company. So different proposals we had to discuss, all three proposals one by one we will talk about. So if we talk about the cash offer, definitely very attractive because it gives you certainty, it gives you speed in the acquisition. However, if you talk about the gain that is being made over here, it's roughly 11 point something, which is lower than the rumored 12% required return which they demand. So they may reject the offer. Proposal number 2 is where we are getting a gain of 15.5%, where it is above their threshold. However, they will have to wait for 3 years for the redemption. So this may be something which not a lot of the shareholders are going to like. And the gain will also depend if the bonds have the same yield, because if they have a different yield, the whole calculation will differ and our calculations will not be accurate anymore. Lastly, if you talk about the third proposal, this is giving you the highest possible gain, which is above the 12% threshold. However, some of the shareholders may like to retain stake in the combined company. Others may prefer to go for cash or for bonds, or to fully exit from the company. So according to us, what would be chosen by the shareholders? I think that the third proposal will be chosen. Now, just saying that I think that the third proposal will be chosen is not enough. I have to give the reasoning also. So what reasoning will I give over here? That I feel that the shareholders are going to prefer to retain, if not all, at least some ownership in the combined company, which will make the share for share exchange attractive? And if whatever assumptions we have taken and whatever synergies we've estimated, if all of that goes well, if all of that actually happens in real world, this option will be the one which gives us the highest possible return. So this is how you will frame your answer for part number C. With this, we have answered all the requirements which were there basis this particular case study, basis this particular question, which is the third and the last question of your AFM pre-December 2025 mock exam. I hope that this video was helpful for you people, and I wish you all the very best for your AFM exams. Bye-bye.